So good afternoon, everyone. Just wanted to quickly introduce everyone up here. We have Daniel Ludwin, Stefan Reed, Rob Hyams, and myself, I'm Tony Kalmakoff. And we're really looking forward to acting in our role as a consultancy and speaking to you as the board of directors of the Pacific and Western Credit Corporations. We've had a lot of opportunity in the last couple of days to really dig into this company. And the title of our presentation is Managing Crises and Growth from the Core. And we believe that this company is in a really strong position to do both. Over many cups of coffee, we basically focused on two key drivers of this company's business model. The first is the niche market lending activities that come from the public sector lending and infrastructure development, residential mortgage lending, commercial development lending, as well as a very small percentage of personal loans. In addition to that, our second key strength and business driver is our operational efficiencies. This comes from both the branchless model as well as the software that we've developed, the VersaBank software and the PW+ account software that really make incent brokers through ease of use, as well as allow us to pass on competitive pricing to various consumers. Now, in terms of immediate and slightly longer term challenges, as I'm sure you've heard in previous presentations, we have a short-term funding impairment that due to a loss of a key broker relationship. The second crisis we want to focus on is a takeover bid by Shoppers Drug Mart. In addition to these two immediate concerns, we also want to look at a larger picture, focusing and examining the source of the negative returns and securities losses that PwC has posted recently, as well as its position in the current credit crisis and how they can, should they choose to grow their business in this economic environment. The recommendations that we want to examine for the two crises that we face, we believe that PwC must manage through the short-term funding crisis and moreover is in a very good position to do so. In addition, in evaluating the bid from Shoppers Drug Mart, we basically want to believe that examine the value of the bid versus rejecting it and use those metrics to maximize shareholder value. Our examination will be threefold. We want to, in terms of managing through the short-term funding crisis, attract funds by increasing deposit rates and leverage our existing liquidity. Second will be the analysis of the bid from Shoppers. We need to value the bid versus protected business growth. And third, if we choose to reject that bid, we need to focus on our core banking strengths to grow our business. I'm going to pass it off to Daniel to examine these two short-term crises.
Thank you. So if we first look at the funding crisis, what I'd like to make sure we understand is that we have a liquidity cushion in place, that we have an internal target of 15 to 20% liquidity on assets, and we're currently at 31. That provides a fair bit of room to work with. On the other side, we have these relationships with the brokers that when we work to provide incentives, these are our customers. They're the ones who are going to go out and get more deposits. And as the spread and the rates increases at this moment, that provides us a little room to provide these motivations to them. So in the short term, we're able to deal with this to accommodate the likely drop in liquidity and to pass through it. If we go on to the bid by Shoppers Drug Mart, it's fairly easy to understand where they're coming from, that this is looking like an attractive company for them. It creates synergies. It allows them to approach that sort of foundation built by President's Choice Financial and Loblaws. And it's mainly built on a stock performance that's doing fairly poorly, not just on an absolute level, but relative to the industry and to some of their peers in this sort of market. On the other side of that, though, we need to make sure that we evaluate this bid and the value of the bid to the shareholders in comparison to what the value of the company could be for them. And that requires a very careful look at where we are at the moment, but also where we could be and what recommendations might change our current position. Following that considering the structure of our company, we're a micro-cap company, we want to make sure that we understand and have good communications with our shareholders. We have a number of large shareholders and a fairly heterogeneous mix. And considering that we have this ability to communicate with them and to block this takeover bid if we should want to, or if they should want to, then we have to make sure that they're aligned in their decision and that we're fully transparent in our communications about the value of the situation to them. And a lot of that builds on what we could be doing with this company. So I'm going to pass that off to Stefan, who's going to run us through some of that. Thanks, Stefan.
So I think one of the things that Dan mentioned that's really important is making sure that our shareholders have enough information to make a proper decision and that we're communicating with them. It's pretty easy to see why some shareholders might think that this Shoppers takeover bid is pretty attractive. Over the last quarter, we've seen our ROA trend into negative territory. One of the things that we do want to point out, though, is that's largely due to a loss on our security portfolio. But we also want to make sure that anyone who's making this decision to sell or not has an indication and has information to understand where the company could go. We made some very high-level assumptions on some of the drivers of returns on assets in the banking industry, specifically an increased margin due to spreads. We've got a fee income growing, and we're sort of keeping our expenses they're going down proportionally to our growth in assets, and also we're knocking out the loss on securities there. So with just those very simple adjustments, we're all of a sudden in an attractive position again. We're a company that's making money. So the question becomes, can we realistically make those adjustments? Well, based on our analysis, we're going to suggest that yes, we can. There are a number of activities that we do better than anybody else in the business, especially in Canada. Serving the niche market, as Tony mentioned earlier, we already have experience with public-private partnerships, municipal infrastructure, all that kind of good stuff. We're competitive in our pricing, and we have great relationships both on the broker side, but also with people who are making decisions about infrastructure projects and big investments. So that drives a high volume of low-risk assets for us. On the other side, we have low operating expenses, and again, this is a key to our competitive advantage in the industry. We have no branches, and we've invested in technology that sort of allows us to minimize our need for human capital. So I'll pass it over to Rob, who will walk you through the end of our presentation.
Thanks, Stefan. Stefan mentioned some of our core strengths, and so in the current climate, we need to now evaluate exactly how we're going to leverage these strengths to generate some superior returns. Well, the first thing is that we have fantastic relationships with deposit brokers, and provided we incentivize those relationships appropriately, we think that with price-sensitive brokers, we can generate significant funding. The second thing here is that we have pursued a low-risk strategy with our lending, and as a result, we have a portfolio of assets on our balance sheet, which is relatively healthy compared to most industry players. Going forward, when we look to aggressively grow assets, this is going to allow us to raise the necessary capital to do so. Also, we have terrific relationships with government. We've touched upon the fact that we engage in 3P lending practices, and we see that there's a lot of runway in that area. Particularly given the current climate, we anticipate that government spending is going to increase, and we like to participate in that. And then finally, we have a risk-adjusted capital position of around 11%, and that's 3% above the mandatory regulatory requirements. So that alone allows us some scope to grow assets in the future. So as I mentioned, the first of our key focuses here is going to be on developing our infrastructure lending portfolio. And we feel that with Canada's their position in infrastructure needs provides a massive opportunity in this space, and particularly in non-major cities. So we continue to aggressively pursue asset growth in some of the Arctic regions and also non-cities like Hamilton, and also places that are developing in areas around Calgary, Alberta, out west, which present opportunities for us. In addition to that, we recognise that one of our very founding strengths here is our operating advantages and the cost advantages that we realise there. That's obvious in some of these metrics here, salaries to assets as well as general and admin to assets. We've got advantages over peers, and obviously that stems from our branchless network as well as our investment in superior technologies. So now that just leaves us with some obvious implementation issues. As we mentioned, the first key issue here is really to address the funding requirements in the short term, and then obviously evaluate the bid that's on the table versus the value of this entity as an ongoing interest for existing shareholders. And then depending on the outcome of that evaluation, we'll seek to evaluate some growth opportunities and implement strategies to capture some of that value.
As I understand it, your response to the liquidity crisis is to incentivize brokers, presumably to go out and provide more wholesale deposits. What happens if that strategy fails? Where do you go from there?
Right. So obviously as a registered bank, we do have access to lender of last resort. I don't think it's in the best interest of the Bank of Canada to let us fail. And we really think that this is very much a short-term issue. So we think in the short term we'll be able to manage through this. And as we mentioned, we think that we can, if not over the short term, over a more protracted period of time, increase deposits again.
I have a similar question in that you've got $500 million in securities on your balance sheet, and given the fluctuation in the credit markets, in the equity markets, you actually may not have an excess liquidity position in a few weeks. So I didn't know if you had done some sensitivity on where you were going to go next, just to build on the previous question.
Am I going down or up here? So we have done some initial analysis on that security portfolio. It might not actually be in here, but what we observe is that we don't really feel like managing securities is part of the core business of this company, particularly given the impact on the capital adequacy. We feel they should divest of those securities and move them into risk-free assets. This is obviously advantageous for a number of reasons. It affects your risk-adjusted asset position, which strengthens your capital position, and it also takes the focus for your top management away from managing capital issues and allows them to go into the market to grow the business. So we don't think that this will form part of our recommendation, and we don't think this will pose a problem as a result going forward.
Do you think there are any avenues to be explored with Shoppers Drug Mart at all in terms of what they've their interest?
So when we evaluated the takeover bid, we really wanted to stick close to let's value what they're offering and what we could potentially be. There are synergies on the Shoppers Drug Mart side. It's certainly one of the things that we know management has been looking into is finding a retail outlet to get into the credit card business. The problem with the takeover bid is that PwC wouldn't actually capture any of that value. All of the value of that synergy would be going to Shoppers Drug Mart. So, sorry? Some of it, right. We would capture some of it through the bid premium, I guess. So given that, we do think that there is a potential match between these companies, something we'd love to evaluate. But in order for PwC shareholders to capture as much value as possible, which is really what we're trying to drive here, we think that the takeover bid is, well, at least needs some serious checks in terms of our evaluation of it.
Given the compelling case you made around P3 as being a great growth opportunity going forward, is there an opportunity for you to actually split the company? Did you consider that between the more consumer credit-oriented part and the public sector funding part?
So I guess the key issue here is scale. We have an asset portfolio of about 1.4 billion, And given that a lot of our strength comes from the fact that we have a very lean operating cost structure, we lose a lot of that if we divide the company into 4 different segments. So at this size, I think we would not consider doing that.
You had one of our the company's advantages as being low operating expenses, but your chart was a good chart. Comparing their expenses were trending up, and the larger competitors were trending down with technology and scale. How do you think that plays out over the next few years, the expense side?
This is why we're so adamant that this company needs to go back to its core. Because the advantage is one of its major advantages is in the operating expenses. There's no question that a lot of the big banks are getting out of branches, or at least reducing the number of branches, getting into online banking. We've already seen, we have our big competitors in PC and Citizens Bank and things like that. Technology as a way to reach your client is certainly it's just gonna grow. So we think that what we can do and what we have done, we demonstrated this with the software we developed for Basel II with the Versa Bank, is that we can do it faster, we can do it better. We have a history of success through creating innovative software and technology solutions. So if we can focus on that as part of our ongoing growth operations, then we think we'll be able to stay ahead of the curve.
I'll just add to that with our asset growth forecast anyway, or at least our goals to grow assets, we actually think that will start to trend in our favour as well, as we're applying basic overheads to a greater pool of assets.
Yeah, in the time that you had available, to what extent did you measure the attractiveness of the Shoppers offer against what you could produce sort of going forward while staying the course? Do you have anything that you can show us in that regard?
So I'm clear you're asking if we did sort of an absolute comparison of our projected values of the projected growth.
What sort of a comparison did you do before you basically decided that the Shoppers drug mark offer should really be not pursued? Well,
to be clear, what we're recommending is that we do some serious consideration of the 2 options. Given the information we had at hand, we didn't feel that it would be prudent for us to do a valuation of a comparison of them. We don't know what the bid premium is from Shoppers, so we can't value what that bid is actually going to be worth to our shareholders. And with our projections of future growth, obviously there are a lot of ifs there, and it's going to take a lot of organizational and strategic change to implement. What we're recommending is that we do a thorough evaluation of exactly what our growth options are, and then present that information to our shareholders and make sure that they have all the information they need to make a sell or no sell decision.
I understand that now.
We'll just stand here.
Again, as you look to the future, are there capabilities that you think you need to build in order to grow against your aspirations that you don't have today?
I think the major one that leaps to mind for me, and perhaps Tony has an addition, but the major one is as we grow assets, though we are a branchless operation and a low operational expense system, we still will need to grow human capital. So it's a matter of figuring out how to use this charter we have to expand to more geographic regions, more sectors, and get that technology out and develop more relationships with more brokers, account managers, that sort of thing.
I think the key as we go forward is keeping it proportional, the expenses. Right now, I believe our loan managers keep about $200 million, and that handles 1 loan manager and 1 support member. So we'd like to keep that growing proportionate to our loans and keep our assets driving revenues.
What's our advantage in attracting deposits? That's a big part of your strategy or your recommendation is that that we have strong deposit inflow. What's our advantage in achieving that?
Well, so in absolute terms of a product versus best-in-class product, maybe nothing. But what we do have is a great incentive structure for the people responsible for selling that product onto the end users. And what we're really targeting is end users or brokers in largely underserved areas or who would be attracted by our products because they're basically complementary to the existing product offering by the brokers.
So in terms of us versus someone else, well,
they're basic GIC and
price?
savings
Is
products.
So it's price that's pulling them to it?
Well, it's the pricing advantage where actually, my understanding of this is that we're translating a lot of that pricing advantage into an incentive scheme for the brokers. We're also offering competitive rates on the products, but I'm not sure that they are necessarily best-in-class GIC and RSP products. I guess they're pretty standard.
That we have the experience going out to these construction projects as opposed to business and loan investing. So a certain amount of relationships and a certain amount of experience dealing with this sort of investing and loaning.